In March of 2010, the Jamaica Deposit Insurance Corporation, JDIC, staged the first Caribbean Bank Insolvency Conference at the Rose Hall Resort and Spa in Montego Bay. Over 20 experts from countries across the Caribbean, Canada, the United States and United Kingdom spoke on issues relevant to the global financial crisis, international initiatives towards best practices and resolutions for bank insolvency. In today's episode, we'll bring you highlights of the presentation by the Governor of the Central Bank of Barbados, Dr. DeLisle Worrell, on risk contagion and financial stability. We'll also present that of Deputy General Counsel of the IMF, Leckow, addressing the international legal framework, institutional preconditions, principal legal issues and cross-border concerns. A veteran economist and graduate of the University of the West Indies and McGill University in Montreal, Canada, Dr. DeLisle Worrell was employed to the Central Bank of Barbados for a number of years before returning post-retirement as its governor. Dr. Worrell has done consultancy with international organizations such as the Inter-American Bank, the World Bank, the UN Economic and Social Council and the CARICOM Secretariat.
If we think of bank insolvency as the disease, I want to focus my presentation mainly on disease prevention rather than the treatment of the disease. I think, if anything, it is we would all agree that disease prevention is always better than cure. And I think that, if anything, in our discussions in the process of the process of managing crises, we have focused too little on the preventative aspect. The Caribbean does not have the capacity for regional stability policy. All our financial stability activities are in the hands of our central banks and monetary authorities, and they are national. And that is the case even though the major risks to financial stability are regional in nature. The CL financial crisis provided a dramatic illustration of the regional nature of financial risk. As a result, in fact, even before the CL financial crisis, the regional regulators have been concerned about regional linkages and what they imply for our risk exposures. And we have established some networks for collaboration in banking, insurance, and securities trading, which I will remind you of later. As yet, we do not have a mechanism for producing and disseminating data on those regional risk exposures and interlinkages. We do not have an ongoing capability for assessing what those risks are and for using early warning systems to help us to detect where we need to take remedial action at an early stage. We do not have policies and systems for crisis prevention, which can increase the resilience of the financial sector and which can enable us to take corrective policies in good time, well in advance of the potential for a crisis. And we do not have a capability of proactive management of financial difficulties within the region. In our small open economies, a loss of confidence often leads to capital flight. So if people lose confidence in major financial systems, they're not going to keep their money in our domestic currencies. They're going to seek refuge in the US dollar. And that is going to cause us problems with the exchange rate. So there's a linkage between financial failure and economic performance. Conversely, economic changes can very often trigger financial instability. For example, if you get very volatile exchange rates and people, therefore, it becomes very difficult to assess the nature of the risk, or the risk becomes very great because of the difficulty in managing your foreign currency exposures. What this means is that financial system stability assessment is about the relationship between the economics and the financial. We are focusing on crisis prevention. So you want to detect vulnerabilities at an early stage. And how you do that is that you have this range of indicators, and you want to combine them into a composite index of vulnerability, where you give the greatest weight to the most useful indicators. Crisis prevention, therefore, the key elements are that you must have a regional decision-making body which meets sufficiently frequently to review the analysis of the risk measures and early warning indicators, and which is able to make recommendations for action to increase financial sector resilience where needed. The existing financial data reporting systems also need attention. They need to be reformed and upgraded. They need to be made more comprehensive, and they need to be, for all the non-banking information, more up to date. If we can put that data together, if we can put the institutional arrangements in place, both for the analysis and for the decision making through some kind of collective apex body, then we would be in a position to detect vulnerabilities at an early stage. And we would have a practical and effective mechanism so that we could take action to strengthen the resilience of the financial system, and therefore increase our ability to avoid crises. If we set up a system like this, that information, the basic information, the balance sheet information, the interlinkages, the prudential information, all that information would be available right from the beginning. Not the details, but at least enough that you would know what the parameters of the resolution would need to be. And the apex body would also be in a position to appoint a task force of the relevant expertise to address, to carry forward the crisis management plan. We got to keep our feet on the ground, but we have to do something, because we are not at liberty, given the gravity of the situation, given the integration of the financial sector, not for the regulatory framework, the stability framework, to keep pace with what is happening.
Ross Leckow. As Deputy General Counsel of the Legal Department of the IMF, Ross Leckow has been involved in the development of key IMF policies. These include member countries' surveillance and financial assistance to countries experiencing balance of payment crises and financial sector reform. He has extensive legal experience in the IMF's regulatory and financial operations.
I'd like to first look at the issues that arise in dealing with bank insolvencies in a domestic context before turning to the questions of cross-border bank insolvency. Now let me turn to three fundamental principles. The first, I think, is that the insolvency of a bank is fundamentally different from the insolvency of a non-financial corporation. I think, as we all know, a bank failure can disrupt the smooth operation of a country's payment system. It can affect large numbers of depositors, including individuals. And in a worst-case scenario, it can trigger a systemic crisis that can bring down an entire economy. Which leads me to my second point. While we will be talking about insolvency proceedings over the next couple of days, I think it's important to remember that bank insolvency proceedings are, I think, in some ways very different from corporate insolvency proceedings that I think many of you are familiar with. Third important, I think, starting principle. When I talk about insolvency proceedings, what am I speaking about? There are many different types of actions that the authorities, the banking authorities, can take in dealing with a bank in difficulty. And insolvency proceedings are really at one end of the spectrum for that purpose. But to the extent that we're looking at a special bank insolvency regime, what are the key issues that a country will have to confront? The first is to, I think, determine whether The insolvency of the proceedings themselves should be administrative in nature and conducted by the banking authorities without judicial involvement, or judicial in nature and conducted through the courts. There's no universally accepted solution to this problem, and each country takes different approaches. The second basic issue concerns the threshold for the commencement of insolvency proceedings. What threshold has to be crossed before the banking authorities can initiate insolvency proceedings against a bank in difficulty? And these thresholds are often set at a point at which the bank, some may question whether the bank is actually insolvent. There is a growing trend towards something called the regulatory threshold that allows the authorities to initiate insolvency proceedings when the bank still has positive net worth, but where its net financial position has fallen below a specified level. A third important issue that comes up concerns the powers of the official administrator. It's important that they have a whole range of powers to engage in restructuring operations, including purchase and assumption transactions, mergers, good bank, bad bank techniques, and techniques such as bridge banks. And an important issue that will arise is the ability of the official administrator to transfer the assets and liabilities of the bank to another bank with a view to restructuring it. In normal times, these types of operations will require the consent of interested stakeholders, such as the counterparties to the transactions or the creditors. But when faced with an emergency and an insolvency, there won't be time to obtain these consents. And the way that we normally deal with this is to advise countries to put in place an express statutory provision that provides that no prior consent from the creditors or counterparties will be required for the administrator to engage in the restructuring. Now, one final issue in this area: systemic crises. What I've described to you so far has to do with the bank insolvency framework that a country will have in place in normal times. But when it's faced with a systemic crisis, I think the situation changes dramatically, where a large part of the banking system may be insolvent and extraordinary measures may need to be taken. These can range from measures such as a blanket guarantee of the deposits of the banking system, a dramatic expansion of the facilities for emergency liquidity assistance, exchange controls, or a deposit freeze. And a particularly important measure in this area concerns the nationalization of banks. Now, what I've described so far is essentially the bank insolvency regime that countries have in place to deal with domestic bank insolvencies. And this is, of course, important that the regime be strong and effective for this purpose. But what about a cross-border bank insolvency? Here, I think the situation becomes much more complicated. And again, a great deal of work is being done in the international community to address this issue by the IMF, by the Basel Committee for Banking Supervision, and by the Financial Stability Board. The basic problem from a legal perspective in these cases is that there's no that essentially banks have become global in their operations, but are resolved through domestic national legal frameworks. The international framework to deal with these cases is really, to put it mildly, far from complete. There's no international treaty governing these issues, and I think there's very little in the way of international best practice. I think while there is a growing call for greater international cooperation in this area, a lot still needs to be done. These are problems that I think, with the sufficiently strong effort and effective international cooperation, can be resolved. And this is an effort to which the International Monetary Fund is committed.
In our next episode, we'll feature the presentation made by Governor of the Eastern Caribbean Central Bank, Sir Dwight Venner, on multi-jurisdiction regulatory governance. You'll also hear from Inspector of Financial Institutions of Trinidad and Tobago, Carl Hiralal, on the necessity and challenges in supervising financial conglomerates that operate cross-border and cross-sector.